Hello, everyone out there. I am Dylan Simon with Kidder Matthews and the Kidder Matthews Multifamily Investment Team here in the Pacific Northwest. It looks like it is 11 a.m. and time to get started. So I want to thank everyone for joining us today. It is definitely an interesting time in the market, and we're really excited today to present a lot of information about the Seattle apartment investment market. First, I'd like to introduce our team just because we have a lot of new people joining us today that we have previously not talked to. And so me and my partner, Jared Anderson, run a 6-broker team, and we cover the entire state, but our focus is on the 4-county region: Snohomish, King, Pierce, and Kitsap. And each of our brokers works in these markets, and we have a definite emphasis in these markets, essentially from 5-unit apartments on up. As far as our specialty, we just closed on just a little over $1 billion in transactions in the last few years, just under 10,000 apartment units sold, and we do have a specialty in development land. And currently we have 23 pending transactions and listings, and a lot of the research and information insights we have today are derived based on that level of market activity that we're working on right now. So we're really excited to make this presentation to you. Following this presentation on Friday, we will be releasing our latest market research report, which is a report on all apartment sales, 5 units and up in the region from 2020. That will be available on Friday, and each of you will get an email with that report. You can also follow this link to get to all of our research. We've been performing research on this market for just about 8 years, and you can access all of that research through our website. The first thing I want to do today is make some introductory comments. And in all my presentations over the years, I've never made introductory comments, but I feel like it's important today because we're in a strange time in the market, and there is a lot of fact, a lot of fiction, a lot of news headlines, and just a lot of changing dynamics. So I want to start with a couple of introductory comments. First is, what we're experiencing right now is a lot of market reactivity versus long run trends. So I want people to keep that in mind as they're listening to our presentation today, as well as they're just understanding what's going on in the market. Next is data validation. The data we have is pretty good, especially on sales data and cap rates, rent, vacancy, concessions. It's not perfect data, and there are some anomalies in the data. So we're really focusing on trended data versus absolute. So keep that in mind. We do try to source the absolute best data, and there are some imperfections over time. Next is, we're absolutely in the eye of the storm right now with what's going on with COVID. I think we've got through most of the worst of it, but the dynamics in our market are changing quickly, and some of those dynamics are actually reversing, even with reports that we're having out as early as this week. So keep in mind that what we're looking for is trying to get some signal through all of this noise, and that we are in a bit of an eye of a storm right now, and we'll see things start to normalize in the coming months. Next is, this time is different. This was a black swan event with the pandemic. It wasn't an economic trigger like a lot of recessions, a lot of market changes we've seen in past decades. It really was a health crisis that triggered this, and not economics. And that makes it a little bit different than previous changes in markets and inflection points. But I also want to add, as we look at all this, that this time is not different. Markets return to previous trends. If we look at historical data trended over decades upon decades, we generally go back to previous market trends. And that's why today we'll talk a lot about market trends, because we expect to go back to those trends and not have big reversals, which is what we're seeing in the market right now. So presentation agenda. First, we're going to talk about 2020 sales. Next, we're going to move into rent, vacancy, concessions, and collections. A lot of information on the market there. Next, we'll move into employment trends. And finally, we'll close on a couple of forecasts we have in the market. So first off, looking at 2020 sales. Now, looking back at 2019 versus 2020, it's a bit of a misnomer in looking at differences, because 2019 was a huge year because the excise tax change. So we saw huge changes in volume. So it was a huge volume year at over 353 apartment transactions and almost $7.5 billion in what was sold. Now, looking at this compared to 2020, we're down about 35% in overall number of sales last year to the previous year. But sales volume is down markedly, about 65% decrease in overall volume from a peak year in 2019. Average pricing is down as well. Now, some of that is just asset values decline, but also over time, we're seeing average unit prices go down just because unit sizes are getting smaller. So we're looking at average price per square foot is a better metric, but we're down there quite a bit as well. Now, some of that is because we've had a lot more suburban sales. Some of that is smaller unit sizes, but a lot of that we'll talk about more is really changes in net operating income, which finally leads to my next point is cap rates. Cap rates aren't off that much from the previous year. We had a low we'll talk about in the last couple of years. It got into the very low 4 cap range, but this is across the region, the 4-county region. Cap rates are essentially the same as they were last year. Now, looking at historical sales metrics and looking at sales velocity, this takes us back to 15 years of data. And as you can see here, we had a lull in 2009 with the last recession. We had a peak in 2016 and then a bit of a decline. And you can see the impact we had with the change in excise tax in 2019. We had a banner sales year. And if we look at the actual number of sales, it really proves how many large sales happened in 2019, because the true peak in apartment sales in our region was really way back in 2016. That was the peak. And what we would expect over time is we'd see those peaks come down and we would come into the next market cycle. But what we've actually experienced is a run up. And the reason for that run up is because we had this excise tax. So if you look at sort of the curve of other market cycles, generally you'd see this come down and then pick back up, which would show we're probably due for it to pick back up again, but we had this anomalous year. So 2020 really was a strange year in sales, both due to the pandemic and also following 2019, which was a banner year for sales. Moving next to average cap rates, we're looking at the nation versus the Puget Sound region. And essentially, since the last recession, 2009, we've had about a 50 basis point spread, which is still in the market right now. You can see here that's about a 50 basis point spread through the pandemic. And also relative to 2019, cap rates haven't changed much. The biggest compression was in 2016, 17, and 18 as we got to the market low, which was a low in cap rates and a high in value. So taking a look at historical dynamics of sales, you can see 16 was this banner year, almost 350 sales, 5.6 billion, and cap rates had started to come down to what we thought was a low until we hit 2018 and we saw further cap rate compression. I'd say the difference here is we didn't really have a big increase in average price per unit. It went up a little bit, but the low was in cap rates down here, you can see here. Moving to 2020, probably the interesting points here is average price per unit's down, average price per square foot's down, but cap rates are about the same. So if we look at sales now, breaking them down on a regional level, and that's where we see some of the greatest differences in 2020 versus previous years. So taking a look at 2019, urban King County, so think west of 405 to the water and up to Ballard and down to the bottom of the lake, those are our 14 urban markets in Seattle. We had 146 sales in 2019 compared to 2020, about half as many sales, but the average cap rate was exactly the same in 2020 as it was in 2019. Looking at North King, sales dropped by 50%. So they dropped down quite a bit, but we also saw a big decrease in cap rates. And part of that is NOI went down quite a bit, but investors were really willing to buy into those markets, and that compressed cap rates on current financials. Looking at East King, it's one of the few markets where we actually had an escalation in sales. Not that many apartments sell in East King every year. We actually had 13 trades in 2020. Cap rates were down just slightly from the previous year. South King, about 50% decline in sales. North Snohomish, about a 50% to 60% decline. South Snohomish, nearly an 80% decline in sales. So a lot fewer sales in Snohomish County as owners assessed the market and decided when they wanted to sell an asset. In 2020 just wasn't the year. Now moving to the south end, what we call urban Tacoma, is downtown Tacoma is urbanizing. 2019 was a banner year over previous years. We had 12 transactions. Again, we had another 12 transactions in 2020, showing a lot of investor confidence in urban Tacoma in Pierce County. And I'd say the suburban market of Pierce County was probably one of the um, most prolific markets for sales in 2020. And it had really some of the best dynamics from a rent growth perspective and occupancy perspective. And it proved out with a lot of investors willing to pay up and meet owners' demands. And we saw a lot of transactions. And then finally, Kitsap, we've been seeing a run up in sales in Kitsap, and we had about a 50% increase in sales year over year from 2019. So it gives a good rundown of what we've been seeing in the markets year over year. Now, looking a little bit more specifically to urban King County, and in urban King County, these are the 14 markets I'm talking about west of 405 up to about Ballard down to the bottom of the lake. And in these markets, we're going to take a quick look at sales history over the last couple of years. And the dynamics that we've seen here is year over year, we've generally seen prices go up on a net rentable square foot basis year over year. And they've picked up through 2019. And we saw a peak in price per unit in 2019 and a lot of sales volume, 146 transactions. Looking at 2020, again, we had about half as many sales this year. And we say a big decline in total volume. And most of that's because mostly smaller transactions traded as larger owners were waiting out the market to see what dynamics would change. And as a result, we saw price per unit and price per net rentable square foot down quite a bit. But again, what's interesting is cap rates stayed about the same. Now, looking North King, the sales up there and looking at those historically from 2017 forward, again, we had about half as many sales. And the trends here is they've been trending up. We've been having a good number of sales every year. Volume's been picking up. Price per unit, you can see, has been picking up nearly every year. And price per net rentable square foot has been picking up every year with steadily low cap rates in the mid fours. In 2020, we saw a reduction in sales of just about 50% and a huge decline in sales volume when you look at only $70 million worth of apartments traded hands. And as you'd expect, price per unit was down, price per net rentable foot. Now, seeing that cap rates are down really demonstrates that NOI was down in those markets, but investors were still paying somewhat of a premium considering a decline in operations. But it remained a relatively strong market, just not with that many transactions. Now, moving over to East King County, this has been the hottest followed market in our region. Without a doubt, everyone wants to be on the east side and take advantage of the dynamics going on in Bellevue, in Kirkland, and in Redmond. And looking at the transactions year over year, that definitely plays out. We've had a steadily increase from not that heavily traded market when you compare to other markets with 50 to 100 trades a year. In 2020, we had 12 trades, which is the biggest year in recent years. Sales volume was, went down a little bit because generally smaller assets traded, but we did see a decline in average price per unit and average net rentable foot. And part of this is we just did not see a lot of NOI growth in these markets as we were struggling to find tenants and push rental rates. There was actually declines, but low cap rates show that investor sentiment was strong and groups wanted to buy in the east side, and that continues, and we expect that trend to continue forward. Now, looking at South King County is one of the most traded markets in our region, and as a result, we can get a lot of good data out of those trades, and we can see steadily year over year quite a few trades, nearly 60 in 17, 55 the following year, and then 2019 truly was a banner year. Sales volume was the highest of any year recorded, just $1.2 billion in sales. And you can see year over year, a steadily increase in price per unit and a little dip in price per net rentable foot, but about the same 18 to 19. Now, what's interesting in 2020, we had transaction volume fall about 40%, about 30% in overall volume, but price per unit went up and price per net rentable went up nearly 20%. Cap rates went down. So unlike other markets, South King County was a market where investors felt very strongly about growth potential in that market. We'll talk about that in a moment in rent vacancy, but it's one of the few markets where we actually saw an increase in pricing and a drop in cap rates, which is attributed to two things. One, investor demand, and two, an actual increase in NOI year over year. Now, moving up to Snohomish County in North Snohomish, So year over year, we had about a 60% decline in number of transaction. Volume is down remarkably. And this shows that mostly it was smaller transactions. We only had $29 million with apartments trade hands in North Snohomish. Price per unit held, price per square foot held, cap rates declined a little bit. So not a big surprise in that market, just a lot of owners of larger assets in North Snohomish wanted to hold on to those assets and wait out the market. Now, looking at South Snohomish County and trades there, we've dropped off remarkably. Now, it's clear that 2019 was a banner year. We tripled sales, more than tripled from 2018, huge increase in volume in 2019. A lot of this was excise tax driven, and we had newer apartments built, and they traded at a premium because they're more recent product. And we saw pretty consistent cap rates in this market year over year. Turning to 2020, a sharp decline, nearly 90% decline in volume in dollar volume. We had a decline in price per unit, and we actually had an increase in price per square foot. Part of this driven by new, more modern buildings were being sold, had smaller units, so smaller price per unit and square foot. Cap rates picked up a little, actually expanded a bit in South Snohomish. Now, moving down to urban Tacoma, which is proving to be an interesting market, looking at some of these dynamics. We mentioned a big pickup. 2012, we had 12 transactions, another 12 in 2020. We're seeing volumes pick up, and we had a bit of an anomalous year in 2018 with some larger buildings trading, the large building trading hands at a really strong premium, but we're seeing cap rates remain low. 2020, we only had one large sale that our team did down there, about a $12 million sale, which accounted for almost 50% of all transaction volume. And we saw a bit of a decline in metrics, mostly because these are smaller, older deals, and those apartment buildings sold at smaller dollar figures. But what we're seeing is more investors interested in urban Tacoma as that market urbanizes. It's definitely a market to watch. Now, looking more to the suburbs of Pierce County, we have some really interesting trends year over year in these markets. And you can see from 2017 to 2018 to 19 and 2020, a huge pickup in transaction volume, number of transactions traded, and steadily increase in pricing. And what we saw in 2020 was really proof positive that investors felt comfortable through the pandemic investing into Pierce County. And we see this on a price per square foot and a price per unit basis, really strong pricing. Cap rate stayed about the same, showing us that NOI increased year over year, and there were a lot of investors interested in Pierce County, proved out by a sheer huge number of deals that got done in Pierce County last year. Now, looking to the peninsula, Kitsap County has been a market that has not been heavily traded, but we've seen the dynamics pick up year over year as investors have been more interested in that market, seeing stability in that market. And we've seen steadily between 6 and 9 apartment buildings trade year over year. Transaction volume isn't huge, but we saw in 2019 pretty good appreciation in price per square foot, price per unit. Cap rates have stayed about the same, which means investors still see opportunity over there. 2019 saw a sharp decline in overall dollar volume, mostly again, smaller transactions, trading hands, but steady cap rates. So overall, some takeaways in the trends in apartment sales in 2020. First off, it's all about NOI. Operations are really the determining factor in pricing. Cap rates remain low for now. And so if you're considering selling, we expect cap rates, if we look at previous cycles, they tend to pick up in these periods. But for now, there's a lot of capital on the sidelines and interest rates are really low. So if you're a seller, it's really all about income. How much income are you collecting in operations? Next, as you can see from the previous slides, all eyes are on the suburbs. A great majority of the sales that we've had are suburban sales in volume and number of transactions. So there's been a lot of action in the suburbs. You've heard about it, you've read about it, and the data proves it out. Next, private owners or sellers. For the most part, most of the transaction volume we've seen with increases have been private owners selling into these times, where the more institutional, larger owners continue to assess the market before selling, trying to find the right time, making sure their assets are stabilized and they're going to get a good return on their capital if and when they go to sell. I expect that trend to pick up, meaning we will see more sales coming up. I think we're a little bit slow start this year, but by mid-year, I think we're going to see more transactions. I definitely don't expect us to hit anywhere near 2019. And for that matter, probably anything near what we experienced in 2016 through 2019. But I do expect that we're going to see a pickup in sales. The biggest challenge right now is what we call the bid-ask spread, what sellers are willing to ask for their assets versus what buyers are willing to bid is wide. And that means transactions aren't getting done. As we talk to clients all across the nation, we may have one of the biggest bid-ask spreads for investment sales in the entire nation for apartment buildings, meaning owners are confident in the value of their buildings and buyers don't quite have the confidence yet to step up in pricing. We expect that bid-ask spread to narrow in the coming months. So that's an overview of sales trends. Now we're going to take a look at operations. And there's quite a bit to talk about in operations right now because we're seeing a lot more concessions in the market, more collection law. So we're going to march through, look at each of these dynamics in a very granular basis to help everyone understand the market, because probably the biggest changes that we've seen in 2020 with COVID and the impacts of it on multifamily has really been at the operational level. So first, I want to take a step back and just look at overall regional trends. And back to our major submarkets, we're looking starting at 2019 data collected from Q4 versus 2020 data in Q4. So we have a good sort of same store sales metric year over year, starting with Urban King County. So effective rents in Urban King County were above $1,900 a month for average rent. Vacancy was pretty healthy at 5.2%. And in 2020, we saw steep declines. And so across Urban King County, we averaged about a 9% decline in rents year over year. I'm sure you've all seen news reports saying rents are down 20 plus percent. They are in select markets for very short periods of time. But all in all, rents have been down in Urban King about 9%. And if you look at the last market cycle from 2008 to about 2011, rents were down about 10%. So it's really not as bad as we've seen before in the past, but it seems challenging based on some select markets. And we'll get into those markets in a moment. And you can see vacancy is nearly double. So that's the big tick up in the urban markets is vacancy. Looking at North King, we've actually added $1 to rent, so not too bad, but vacancy has gone up. And as a result, NOI has gone down, and that's why we've seen a decline in cap rates in North King and a decline in values, but cap rates have gone down a bit, mostly because we're not collecting as much income because the buildings are a little bit more vacant. Looking at East King rents are down by about 3.5%. So mostly driven by newer products. So not quite as strong of a decline as we're seeing in Urban King, but a bit of a decline. Now, vacancy was higher in East King because a lot of new product had been delivered in the last couple of years, and everyone was trying to stabilize those buildings. So we added about 0.8% increase in vacancy, which is not too bad considering the effects of the pandemic in the more urban markets. Now, looking at South King, we added about 2% to rental rates, which isn't too bad, but we did see a big increase in vacancy in South King. And we'll get into that in a moment of just hunting for the right pricing between where you price the unit and how much vacancy is in the market. Now, looking at Snohomish County has done pretty well. We've added about 1.5% to rental income in the form of effective rents, but we have seen an increase in vacancy, not the worst in the market, but we're trying to find equilibrium. It's a pretty stable market in Snohomish County right now, but we're certainly not growing that much. Now, looking at Pierce County, this really tells the story of investors going down to Pierce County. Through 2020, in the last 4 quarters, we were actually able to grow rents by about 3.5% and went a tick down in vacancy. So vacancy has been very stable. Although we're growing rental rates, we're doing it without losing much in trading for loss of occupancy. And that's why we've seen good NOI growth and investors confident in those markets. And that continues in Kitsap County as well. So looking at Kitsap County, we're seeing about a 2% increase in rental rates, and vacancy has stayed about where it's been the last couple of years. So it's remained a very strong market in Kitsap County. Now, taking a look a little bit more localized trends on a submarket basis, taking a look on the left-hand side, these are actual, if you look at the bottom graphic or the bottom line, this is actual growth in rent that you see across here, all the way up to 10%. Puyallup, Auburn, Tacoma, Federal Way, all have seen 2.7 to about 5.2% increase in rental rates over the last year. This again is Q4 2019 to Q4 2020. Really, really strong growth, and less growth, but still positive growth across Bothell, Kenmore, Kent. So these have been growth markets across the last year, which really is a testament to the strength of the suburban markets in our region. Now, looking over to the right, these are actual declines. So when I mentioned a bit ago that we're down about 9%, that's the average from some of these shallower declines on the east side right here, just about 25 basis points, up to Lake Union, which is definitely hit hard by Amazon and the rest of the employers not filling up those office buildings. We're getting near 20% year over year declines in rent. Now, we're talking a moment about the difference between concessions and rental rate declines, but effective rents can be down as much as 20%, but it's been for a short period of time. But those markets certainly are experiencing some challenges. And you see this goes all the way across the east side. So it's not just downtown Seattle. We're having some challenges across all urban markets right now. Now, I want to take a little bit more granular look at urban markets and how this is broken down as older buildings built before 1995 and newer buildings, and looking at the impact of time as well as COVID. So this takes a look back. What you're first going to see here is asking rents. What you're next going to see is effective rent. And really the difference between the two is concessions, what landlords are asking, what they're actually getting in signed leases. And we've seen really phenomenal growth. If you look at where we are here, this was the last recession, 2007, 2008. We had a decline in the market in 2009, and we've had a very steady run up through 2019. So it's been really a terrific market for older buildings. It was a little bit milder growth in the early years, and that growth picked up in rental rates. And you look at vacancy, has stayed really low, and pretty much year over year, it's declined. We see in this area it picked up a little bit, and that's really because you look here, landlords are asking for more rent. A lot of these landlords that own older buildings is to make up for property taxes and utilities that increased in the last couple of years with tax assessments going up. And they had a bit more vacancy, but then it shot right down again. So it's been very strong in these older type buildings. Now, looking at the last 12 months for buildings built before 1995, this is asking rents, this is effective rents, declines. Now, if you look at the scale here, the declines are not as bad as it looks. We're going down to effective rents. We're about $14.90. We're going now down to about $14.40, $14.35. So it's not a big decline, but it is a decline. And what you'll notice on the next couple of slides is this is the differential. This is the concessions coming into the market. And this is the difference between asking and effective rents. Now, looking at vacancy, as you'd expect, vacancy has ticked up. So we're low vacancy coming into this. We were about 5%, market equilibrium, what I'd call, and now we've picked up to about 7%. Remember that number because we're going to compare that to more modern buildings right now and looking at buildings built after 1995. First, a historical look. So we can see asking versus effective, pretty close. We can see a differential, this gap. These in recent years, we've added a lot of supply in these urban markets. And as a result, you can see really a lot of choppiness and vacancy. Now, what this proves is a huge amount of demand in this market in 2016, 17, and 18, really pent up demand. And it took hold in 2019 with a lot of new office buildings delivering, residents moving in, and vacancy dropping down. And this is the last 15 years, shows a really strong market. Now, moving to the last 12 months, again, we're going to see these big changes. We're going to see a drop off. Now, how this is scaled, we're talking several $100s. We're above 2,200, and now we're below 2,000. So we've seen about a 10% drop, which we talked about before, around 9% in the urban markets. But the bigger change here is the amount of vacancy. So that last slide with older buildings, it's around 7%, or more like 11% in newer buildings. So that's something to pay attention to. looking at the vintage of the buildings, whether they're professionally operated or not, and their location has a major impact in how they're operating. So to that point, let's take a hyper granular look and look at a market like Capitol Hill. So we're just going to do this study with newer buildings because they've been affected a little bit more than older buildings. Now, this data, I can't quite square why asking rents went down from 2005 to 2019. I think we just got something happened with our data set. We researched it and we think we have the right data. But what I want you to focus on more is effective rent. And effective rent, you can see from the last recession, it had a bit of a lull in 2009, but it's really picked up from 1,500 to about 2,150, 2,200. Although we've got a big scale here, so you can't see that it exacerbated, but that's a huge run up from 1,500 to nearly 2,200. So really strong growth. And here's overlaying the vacancy. We've had a lot of spikes in vacancy because this includes newer buildings getting added and the market trying to find equilibrium. But during this time, we grew rent almost every single year, had a little bit of a lull in 17 and 18 as we were getting new offices delivered. And we had to get those delivered before the renters could move in. But we ended with really low vacancy, around 5% coming into end of 2019. Now, looking at the last 12 months, I'm sure anyone who's participated in this market can guess what these slides are doing. So if you look at this scale, we've gone from about 2,100 to 1,800. So about a 15% drop off in rental rates in Capitol Hill going through the pandemic. Now, market research that's come out as recently as Monday this week is we're starting to see some more rental rate increases in the urban market. So that's why I'm asking everyone to take this data with a grain of salt. It's all historical, is we're already seeing some corrections in the market. But you can see here, we've had this inflated vacancy. So these are markets to watch. I expect these markets are going to start to correct here pretty quickly. I think we've got through the eye of the storm. We've seen a drop off. It dropped off quite a bit. We're now tapered. Same thing with vacancy. We had a peak and now it's tapering. So it looks bad, but it's trending better. Now, one more look, West Seattle. We'll go through this quickly, but as you can expect, historically, West Seattle has done well. We've added a lot of new product kind of mid-decade. This has showed up in the form of spikes in vacancy, pardon me there, and we've had some concessions, but we ended the decade very strong, huge amount of rental rate growth, low vacancy. Then the West Seattle bridge shut down and COVID hit. So you can get these curves, but I think what's important is when you look at these curves, these declines have flattened in the last couple of quarters, and so has vacancy. So I think we've got some good hope that we've seen the worst of it. And that's why I wanted to show these slides is I think we're getting through a lot of the challenges. They're hyper localized, so you can't paint them with a broad brush. So before we get to the suburbs, we'll do a couple of urban insights. One, rental rates in the most challenged markets are off 10 to 25%. It's hyper localized. I don't think it'll be here for long. We're through the worst of it. But I think the bigger challenge is vacancy, is getting those units filled back up. Many owners in some of these markets are having trouble getting to 85% occupied. So wintertime is always a challenge in Puget Sound. We're now getting into the spring months. We're in February. Yay, it's feeling good. And I think we're going to pick up from there. Concessions, not just for new construction anymore. We'll talk about those in some future slides in a moment. And then challenging markets. Right in the heart of Capitol Hill, North Capitol Hill is not suffering nearly as much. It's a strong market, but right in the heart of the Pike Pine corridor, we're having some challenges, especially where we have the Chop Chaz going on over the summer, West Seattle due to the bridge, and South Lake Union. And then each market's going to behave very differently. I've made this point several times, but the dynamics are very localized. So make sure you're studying those as you're analyzing anything down to the sub-market or asset level. So next, we're going to take a look at the more suburban markets. We'll start with North King. Again, this is asking rent versus effective rent. This slide really demonstrates the growth. Here we are growing from just about $1,050 a month, getting all the way to nearly $1,500 a month. So tremendous growth. Along the way, some choppiness due to both pushing rental rates and adding a lot of new product. But we ended up the end of the decade about 5.25% vacancy. Really, really strong market in North King. Now, looking the last 12 months, now you can see these declines are much shallower. If you look at the scale, we were just over $1,500 a month. Now we're just closer to about $1,480. So not that big of a drop off. You can see here the concessions in the market, not that much in the way of concessions, but there have been declines in North King. And next, we've had some elevated vacancy. But again, we're starting to see rents pick back up. You can see quarter over quarter and vacancy decline. So it's starting to stabilize already. Looking at East King, last 15 years, no big surprise, a lot of rental rate growth. Here in this scale, we're going from about $1,250 a month right here, all the way up to nearly $2,000 a month. Been very strong growth. As I alluded to before, we've added a tremendous amount of new supply of modern vintage apartment buildings. So we've had some choppiness in vacancy. We ended up around 7%, which, consider overlaying this rent growth with vacancy, has not been that bad. If we stripped out all the new buildings, we'd probably see vacancy rates probably closer to the 4.5%, 5%, not this elevated level. Now, looking at trends in the last 12 months, well, this looks much more like the urban markets. We've had a big drop off from where we were. We were seeing rents coming into 2020, mid 1900s to 2000 a month. We actually had some spread right here. What we're seeing here is owners hunting, trying to figure out if they can stabilize pricing. Weren't able to because effective rents are lower. And now we stabilized and we're actually seeing growth again in this market. Now, moderate growth, but growth nonetheless. And that's really occurring in the winter. I'd say vacancy, the same type of thing. We've had higher vacancy, but it's starting to tick back down from a high. So East King's doing well. We're seeing a lot of delivery of new apartment buildings, but a lot of shift in demand to the east side as people are looking for more space. And we're seeing this with investor demand. My forecast is we're going to see a lot more sales in East King, and they're going to be very high price sales. Now, moving off to South King County, historical, this has been a very strong market. Here are asking rents versus effective rents. One thing I'll point out in this market is you're not really seeing a run up in pricing until about 2012 to 14, whereas before in the urban markets, we saw a bigger run up earlier. So it took a little while. We saw people getting pushed out of the core. Those that have heard us present before, heard about this trend that the rents went up in the core first. South King has been one of the strongest markets. We essentially went to rents from $900 a month here in 2005 all the way up to $1,400 a month on average. So a huge run up in rental rates. Vacancy has been a little bit choppy. We've been raising rents. This is us getting out of the recession. It's picked back up. This isn't new supply because there's not a lot of new supply. It's really renters getting pushed into further out markets looking for deals and a lot of acquisition rehab buildings pushing rental rates. Now, looking in the last 12 months, I'd say this is really indicative of investor demand. South King County has essentially grown rents. Now, there's probably some landlords out there saying they haven't, and there's some markets that are more impacted in the last 12 months than other. But in the totality in South King County, we have seen a difference in asking versus effective, but we have seen some growth. Now, it's been fits and starts, but we actually see growth from the beginning of the year to the beginning of last year, the beginning of this year. And we've done that with elevated vacancy rates. So South King has performed well, an increase in rents by a touch, but also added with an increase in vacancy. Now, moving to Snohomish, similar trends as we saw in South King, very similar trend lines. Looking at the last 12 months, we've actually saw a pretty big run up as people moving out of the core right when COVID hit, looking for better deals, stabilized a bit. Rents have gone down, but we're now starting to see them pick up just a little bit quarter over quarter, which is good news. The challenge is the vacancy rate continues to climb. So with that, we've got to keep an eye on Snohomish County. Probably going to have to see rental rates tick down just a bit to get this vacancy in check. Now, moving to the South Sound in Pierce County, we're seeing some very different dynamics. And this is what I alluded to talking about sales, is investors have a lot of faith in Pierce County. So here's the trend line of asking versus effective. This is the same topic I brought up before. We really didn't see rental rates ticking back up until we hit about 2014. A bit of a lull in the market trying to recover from the last recession, but there's been a strong run up since that time. and vacancy has stayed really low. Here you see landlords in this area hunting to find equilibrium in rental rates as they continue to push them, but vacancy has stayed very low in these markets. Now, interestingly, turning to COVID times and looking at the trend line, really strong trend line, both in asking and effective rents. Landlords have essentially nearly closed the gap in what they're getting for asking rent versus effective, and it's grown almost every single quarter. It's tapered a little bit, and you can see that, but also vacancy has tapered off. So my expectation is if we can keep that vacancy low, we'll see rental rate growth occur in Pierce County. So it's a testament to the strength of the county and also validates a lot of investor demand last year. Now looking at Kitsap, very similar to Pierce, we didn't see landlords start to increase rental rates till pretty late, about 2014. It was a slight run up, but then a strong run up after that. Nearly no new supply, more acquisition rehabs pushing rental rates over there. And we see that a little bit in the vacancy data. But these are the points of inflection where vacancy drops start to push rental rates. And these show really good curves. If you can continue to push rental rates and keep vacancy flat, you're doing really well. So the last 15 years, really, we've seen a really good pickup of vacancy drop from previous years and rental rates increase. Looking at the last 12 months, again, very similar to Pierce County, where we've had a run up in rental rates, both asking and effective. Haven't quite closed the gap nearly as effectively as we have before in Pierce County, but still year over year showing rent growth in Kitsap is a strong signal to landlords that it's a strong market, and vacancy is very low in the peninsula. So I want to turn next to concessions, and concessions is really something that we had not looked at much before, because if you look at before 2019, concessions essentially were fairly low. About 20% of buildings were offering concessions to the market, and most of that was newer buildings, and the concessions tended to taper in the after we got through the winter months. It was a tool for new buildings as well as in winter months to keep buildings full. Looking at 2020 and beyond, this is what we expected them to taper. What we didn't expect for them is to pick up. And that's what we've really seen in this COVID era, is we're getting up to nearly 50% of buildings are offering concessions. Now, this is out of all buildings. Now, the distinction is this line shows downtown markets. So quite a bit of concessions in downtown markets versus suburban markets, where concessions, not too different than previous times, are definitely higher, but the real delta is seen here is urban versus suburban, where suburban concessions might be a week or two, and the urban concessions are what we're seeing is as much as 3 months, anywhere between 1 month and 3 months. And 3 months is about 25%, which is the sharpest declines in effective rent. Now, looking at this a little bit more granularly, we're looking at Urban King. The first thing we're looking at here, this is a little bit of a complex slide, is this is number of properties not offering concessions versus offering concessions. So the stock of buildings built before 1995, the great majority are not offering concessions. So this is just about 25% of those buildings are offering concessions. Roll forward to buildings built after 2017, nearly all of them are offering concessions. And that concession rate, as you can see, picks up based on the vintage of the building. The newer the building, the more concessions. This is a bit of a misnomer. This shows about a week and a half of concessions. That's because this scale is based on all buildings, all markets. If you look at this, that's a week and a half. That's probably the least amount in Urban King. The trend is somewhere between 1 and 3 months right now, but we're beginning to see that taper. Similar dynamics in East King, but I'd say that the bigger difference in East King is some of these buildings that were 2005 to 17 aren't having to offer concessions, or the ones that are pretty minimal. It's really the competition among newer buildings that are offering the most concessions. That market's absorbed really well, whereas in urban markets in Seattle, buildings that call it 2005 to newer, almost all are having to offer about a month or so of concessions. Now, the final metric that is really important, this sort of, if you look at the 4 components of income of rental rates, occupancy rates, concessions, is collection loss. Some of the hardest data to collect. What we're looking at here is data from the Washington Multifamily Housing Association. I want to thank them for collecting this data. They do it every 2 weeks right now, and they started doing it during COVID. So it's really helped us get an understanding of collection loss. And this first is Seattle on the east side. You can look at here, in May, this is in April, about 5%. We ended the year here, the last data point is December, about 5%. And that's about what we're seeing in the urban markets is 3 to 5% collection loss. Some buildings are collecting 100% of rent, and this is really non-payment from tenants. Now, looking at North Sound, we've got, it's ticking up. We're closer to about 12%. And it's been picking up month over month over month, as you can imagine, with lack of stimulus checks and people's savings accounts running down. South Sound, pretty similar dynamics. This last one, Peninsula, I can't really explain. So, but I'd say in the suburbs, we're looking at somewhere between 10 to 15% collection loss, in the urban core more to 3 to 5%. But it does impact NOI, and it is a major contributor to how landlords are having to effectively price units right now and what kind of rent they can collect. So I want to turn a little bit to forecasting real quickly as we finish up rent and vacancy. So rent forecasting, these are predictions from CoStar for market rent, asking rents in the market. Not any big surprise from 2010 to 2020, major run up. Asking rents took a decline as of March, which brings us to current. What I like to see here in this forecast is they expect by Q3 of 2021, we're going to be in this point of picking up, and it's going to be some fits and starts. This is seasonality that you see here. Rents are, asking rents go down a little bit in the winter months, but generally we're back to this previous trend line. We'll see how good I can draw a line here. That's why I have confidence in this region. Now, these are just a forecast. It's based on econometric models. This is their base case. It looks pretty good. The question is how much rent, where are you located and how much rent growth you're going to get. And in the urban markets, if you do a sub study of this, it's going to take a little bit longer for these rental rate increases to take effect. Now, forecasting of actual market rent, this is what you're getting effective rent. Where we were here, this is about 3 to 7%. Call this 2012 here to 2019. This is a huge amount of accumulation year over year of rental rate growth in our market. And that really was impressive of what we were able to accomplish this last decade. No big surprise here. Dropped about 2.5% year over year to where we are today. They expect it to run up. And then here we are in the next couple of years. And we're going to see, the expectation is 2.5 to 3% rent increase year over year for the next couple of years. I think we're going to see a bigger pickup. I think we're going to see this curve pick back up here, which is essentially what we saw in this other previous years, another bad circle drawn by me. But their models just can't really capture reality. I'm looking at more what's happened in previous decades, and we've seen in almost every decade rental rate picking up mid-decade. I think the bigger question here is vacancy forecasting. What we're looking at here, this is the last downturn. This is sort of the remnants of the last downturn. It took a while to eradicate vacancy across the market, went down by 2014, and we spent the better part of half of a decade with really, really low vacancy rates. As you can imagine, here we are coming into the COVID era. Across our region, we're about 7.2% vacancy. Compared to pre-COVID, we were about 4.8%, so it shot up. The predictions are it's going to go higher. And so really coming to this point of what we're doing is trading rental rates for vacancy. We've kept buildings full. As we start to push rent, we're going to see buildings get a little bit more vacant, but we should capture some of that with higher rental rates as we get through this year. And then we're going to start to see vacancy come back down. Their expectation, it's going to take a couple of years. We'll have to see. Looking at trends in the market, some key takeaways. First one is rent. We've likely seen the worst in declines, but really the question is balancing rental rates versus vacancy rates versus concessions to see how much rent you can actually collect when you sign that lease and how full you can keep your building. Vacancy, we expect to remain somewhat elevated, more so in the urban markets for a bit of time. Suburbs haven't had as much challenge with vacancy right now. It's more about trying to grow the rental rates while keeping stabilized vacancy. Concessions, highly variable on ownership and submarket. What I mean by that is some landlords are keeping rental rates just as they were pre-COVID, and they're dealing with lessened demand by offering more concessions. One owner's 10% reduction in rental rates is another owner's, call it 6 weeks, 5 or 6 weeks in concessions. And submarkets are making a huge difference in where concessions are offered. And finally, collection loss, we discussed that. It's greatest in the suburbs, and it's really impacting sales value. That's where it's coming out, is lenders do not like to see that collection loss. They're trading as vacancy. We discussed this during our last presentation. Finally, we'll move on to employment before we wrap up here. Looking at the employment, this is good data. This comes from the Employment Security Department in Washington. The last 3 years, really not a big run up at all. It's pretty stable. You can see here, this blue line is Washington State. We have this large peak go on right when COVID hit. And these are the submarkets down here that we're discussing: King, Pierce, and Kitsap, and Snohomish counties. What's interesting looking at this data in the last quarter is there's been another run up here in unemployment claims. But interestingly enough, we've seen no run up in our urban markets and in our suburban markets we've discussed. And what that tells me is the greatest unemployment concerns are out of our core, Western Washington markets. It's mostly in other markets that are not impacting the local apartment market here. Next is taking a look at unemployment rates across the region. King County went from 15% down to 4.3. This ticked up a little bit in December to 6.1. I expect it to go back down. Same thing in Snohomish. We've seen each one of these markets drop off remarkably. So where that's really data proving out is in office rents and vacancy rates. So the biggest challenge in the market this year has been really absorbing new construction. So we've seen our first negative absorption year in recent memory. And you can see from rental rates, that's been the impact on rental rates, is they've gone down a touch, not too bad. The bigger concern is vacancy. So we're watching the market closely. Most of it's sublease space, but we're just not seeing people go back to work yet, and we need to remedy this. Looking on the East King market, again, some negative absorption, but a huge amount of new construction coming into the market. Interestingly enough, even with negative absorption, rental rates have not dropped off that much in East King, and vacancy it's ticked up, but it's still much lower than where we are in Seattle. So we're taking a close look at these trends. My expectation is people are going to get back to work, and we're going to see a very stable office market, but we're just in a very challenging time right now without new leases really being inked. So the big question is, back to the office or not? So just a really quick rundown of when people are coming back. The saying in the market is July is the new January. So essentially, Facebook doesn't plan to come back till July. Same thing with Apple. They're revising these constantly. I thought it was interesting. Netflix is going to base people coming back on vaccines. What percent of their workforce has been vaccinated? That's going to help them come back to the office. That's their metric. And the other thing that's coming out is flex, hybrid, and distributed workforces. So many major employers are looking at this. I don't believe this is really going to take hold. I think we're probably going to see the great majority of people come back to work. That's a whole nother presentation. But key trends as far as employment or key takeaways, the unemployment's elevated, but it's stabilizing. It's coming back to the normals we've experienced before. Urban versus suburban. Urban job growth continues to be strong. We're seeing a lot of jobs enter this market. It's just office use remains low. And that's the biggest challenge we're experiencing in the market. So overall, it's the economy versus commercial real estate. The Puget Sound economy is booming. It continues to boom. We're still seeing tech companies in-migrate to this market. We're seeing job growth. We're seeing hiring. They're just not coming back to into the office space. So commercial real estate, whether it's office, high rises, or apartment buildings, we need to return to the office. And it's somewhat binary. Once we return to the office, I think we're going to revert back to the previous trends we had. Maybe there'll be a little bit more growth in the suburbs, but that was happening before. We saw growth in these urban suburban markets before. So we break our forecast down into near-term challenges, then a little bit more on longer run. So first, in the near term, where I believe apartment owners and investors and developers should focus, one, urban core, it's really about balancing rental rates with concessions and vacancy. How do we keep buildings full, stabilize rental rates, and not give too many concessions? So that's really the big focus right now. I think we're in a highly stabilizing period in the urban core. I think we've gotten through the worst. It's a matter of just growing. And mark my words, once these employers come back, we're going to see these rental rates shoot right back up. That's the exact same thing that happened last cycle. It's just hard to see it in the middle of the storm right now. Next is suburbs. Really, it's about collecting rent, minimizing that collection loss and pushing rental rates and keeping that balance. The suburbs are doing well. Some of them are nominally challenged with collection loss, but really it's about finding that equilibrium and getting your tenants to pay rent. Next is where to focus is operations and expenses. I really advise owners to retool your technology right now. There's a lot of technological solutions for keeping expenses down, great marketing tools in order to keep your buildings full, a lot of interesting tools about marketing your buildings, touring that have come about. It's probably one of the best things that's come out during COVID is it's really forced us to use technology and really enable our leasing and our rent collection through technology. And finally, monitor expenses. And some of that's by retooling your technology. Part of it is just focusing on areas where you can cut back, and maybe it's fighting tax assessments. May have some assessors on the call today. I understand that it's hard to assess these buildings, but values have gone down and tax assessments have gone up in the urban core year over year. So right sizing that is going to be a challenge in the near term, but it will definitely help the bottom line. Next point, sellers. If you are a seller, it's all about NOI. Interest rates are really impacting pricing in a phenomenal way. We have a lot of clients that are doing really well by keeping their buildings full, collecting good NOI, and taking advantage of low cap rates. So if you are a seller, I expect we're going to see cap rates are going to expand at some point as we get through the challenges in the market right now. Now, if you can get strong NOI out of your building, it could be the right time to sell, but otherwise you're really focusing on collecting income. Next, is this a new normal? And I don't believe it is. I really caution people to not confuse market reactions with long-term trends. I call it my Mesopotamia theory. People have been, collecting at the river bend since the dawn of time. Our river bend is downtown Seattle, South Lake Union. It's forming in downtown Bellevue right now. I think if you think those markets are not going to thrive, you're throwing out thousands of years of history of where innovation occurs. And innovation, whether it's trading in the souks of Dubai or it's the waterfront of other markets, it's always been in these dense urban cores. I think we're going to return to that. I think the suburbs are going to be strong. We're going to have some strong suburbs, but I think that's just pushing on a trend we've already experienced in the past. Finally, long-term forecasts and key takeaways. I really looked long and hard at the slide from when I presented to a lot of you just 4 months ago. And frankly, I didn't change the slide too much. I think the forecast is about right. Seattle is going to remain one of the strongest economies in the nation. When I say Seattle, I'm talking about Puget Sound. I think I put Seattle here because a lot of people are concerned about what's going to happen in Seattle. I'm not at all. We're doubling down on Seattle. Love the market here, but I think as a region, we're going to remain one of the strongest around for a lot of dynamics we've talked about in the past. Global health, science, technology sectors, I very much believe they're going to lead the recovery. We're already seeing some of that right now. Bioscience is doing absolutely terrific. I expect that to continue. A lot of these other companies that are in the innovation sector can easily make pivots. Getting into science is going to help. I know Microsoft is assisting the state of Washington with vaccine rollouts. We have got the technical know-how that's going to continue to make us strong and lead the recovery. I think everyone will agree that we're recovered in 2024. The real key as an investor, owner, developer is, when can we take action? And I think we're going to start to see early signs of recovery by the end of this year in mid-2022, but they're not going to be broad. And I think it's going to be hard to really understand the trends taking hold. So I really recommend you look at long-term trends and don't wait too long. I think now is the time to be making investment decisions because really going to see the market pick back up. And I know a lot of people in 2020, 2014 that really wish they would have invested in 2010 and 11. That's where we are right now. It will be a bumpy ride, but hang on. I very much believe we're one of the best regions in the world. And I applaud all of you that joined us today, because you're here for a reason. You're interested in the Seattle apartment market and the Puget Sound apartment market. Again, just a reintroduction to the team. I encourage you to reach out to our team with any of your needs. Really want to thank everyone for your time today. As far as follow-up, visit our website for our active listings. You can get all of our research. Again, this new market study will be published Friday. You'll get a link to it through our newsletter. If you're not on our newsletter, you should get on our newsletter. You can do so on our website. And finally, if you want to learn a little bit more about the team, again, I'll refer you to the website. Really want to thank everyone for joining us today. Want to thank our team to make this happen and supporting me and putting these presentations together. Want to thank my partner, Jared Anderson, for all his support in me doing this. And really want to thank the marketing team at Kidder Matthews. You did a terrific job with this presentation. So with all of that, everyone signing off. I want to thank you for joining today. Look forward to hearing from you and wishing all of you well. Thank you so much.